Well, this is another episode of the Growth Game podcast. I'm CEO of Meritus Capital, and we are absolutely thrilled that we were able to have Patrick Morin on today with us. Patrick has a lot of experience in the staffing industry, and boy, this is right on point for my audience, and really appreciate your taking the time today, Patrick.
I'm thrilled. I've been looking forward to this ever since we had connected.
Sounds great. Well, excellent. One of the things I love about this podcast is a lot of times we make these natural conversations even be the introduction of who each other are. I think it just is more interesting that way than something that's totally pre-planned and canned. So I appreciate this is, I think, the first time we met.
I've heard that on Letterman and Carson, they don't like to see the guest before the actual show, right? It's like, Stay in the green room. You're all good.
Exactly. It just makes it so much more natural. So thanks for coming in. It's really amazing that we haven't actually, being that we've both been around the staffing industry for so long, met each other directly, but this is great. We get to do it. So maybe I'll just go first. I'll tell you a little bit quick about my background and how I intersect in this industry. And then you can do that the same. And then we'll kind of go into some of the fun growth game learnings, pattern matching, so my audience can figure out how they can make more wealth out of what you and I do for them, right? So, So Patrick, I am a non-banker, although I've been providing finance to the staffing industry since the early 2000s, late 90s, early 2000s. I'm older than I look. Been doing this a little while, but primarily got into the business on being the entrepreneur. I came from a long line of entrepreneurs. They were essentially in a specialty staffing type of business. Went right out of school. I started a family really young, and I started my first business basically in the specialty staffing type of business. And I grew my business, Patrick, in that next 8 years or so with an accounts receivable funding company. Grew it pretty big. We had about 100 employees internally. It was a nice small business. We were making good money. But I decided I loved helping people grow so much that I sold that business and I transitioned into being the actual funder. And so since then, I've built 4 different funds. I've sold 3 of them. Now really focused on the current brand, Meritus Capital. And again, we're spinning up the transactions here. We have many hundreds of staffing agencies in our various funds that we're in right now. But I've funded somewhere around 800 staffing companies over the years. So I love it.
Wow, that's actually an appreciable. You get 17,000 staffing companies in America. You actually have an appreciable percentage.
Yeah, it's been great. Of course, those have been over the many years, and many of them have actually gone on to sell, which we're going to talk about today. It's been really a great ride. We do high growth startup all the way to our largest client right now is about a $400 million staffing company. So we've got a pretty wide range. Even though we are not a bank, we're actually able to do some things that are fairly unique and even sometimes larger than some of my bank competitors. So that's about me, but that's not what this podcast is about. That's who I am. I love helping staffing companies grow. And that's what this is about, the growth game. And so, Patrick, love to hear about your background and your intersection to the staffing industry.
Sure. We're based out of Richmond, Virginia, but you can tell by my accent, I am not necessarily from here. I'm from a very small town in upstate New York. And right in the smack dab in the center of upstate New York. And after college, I went to work. I was fortunate enough to work for General Electric during the Jack Welch days.
Beautiful.
Yeah, you can imagine for anybody who's listening who's on the older side of things, they know exactly who he is. For anybody who's younger, go get a book because there's a lot of lessons, a lot of good lessons there, especially when it comes to growth and it comes to strategies.
I agree.
But after General Electric, I went down to Wall Street. From there, spent a couple of years down there, and then moved down to Richmond. And in Richmond, I had a very curious career arc to ultimately get to where I am now. We started off, we grew a REIT. I was able to join a REIT and grow it, and we grew that into 30,000 units in 5 states. It was listed on the New York Stock Exchange, and then it was eventually sold in 2005. And then from there, did a couple of tech startups with some compatriots. One of them measured the beer that comes out of the tap against the money that goes into the till so we could tell which bartender was stealing. right?
That sounds like fun.
It's not bad. If you've ever seen Bar Rescue, we get that mentioned from time to time, and it's a great thing.
Nice.
But from there, I did some additional ones before joining with Transact Capital in 2012, and I've been here ever since. Focused predominantly in on the staffing industry.
Right.
Yeah, and it probably half of our deals actually come out of human capital management. And it wasn't an accident. We did not just kind of stumble into the industry. It was actually a choice because what we were looking for a pretty wide a total addressable market. And as I mentioned earlier, you get 17, 18,000 staffing companies in the United States. You realize that they are the mortar between the bricks of our economy. They really are what allow our economy to function, to be able to expand and contract, with demand and declination of that demand, contraction of demand. And what we started to realize in this space is that there definitely needed to be players that could come in, understand it, investment banks that could come in, understand the industry, understand the challenges that the founders and the CEOs had, and then ultimately be able to guide them to an exit. And so we have been doing that really since 2012 with the firm. Even though the firm is 25 years old, we really turned and focused and concentrated on this particular industry a while back. And it's not just me. I'd love to say it's just me. We are not a one-man shop. We've actually got 16, 18 guys right there in the back. And we address most of the major conferences, SIA, ASA, the Wisconsin Association of Staffing Services, up in Massachusetts, down in New Jersey, down Florida, just about all of them. So we have a pretty heavy presence there. It sounds a lot more glamorous than it actually is.
Yeah, sometimes I feel the same way, right? Sometimes it always sounds more glamorous and better on the other side till you get in the trenches and you realize the complexity of what it takes to actually do what we do, right? In our various professions here. But you're in a place where you get to speak to people when they're looking to do something exciting. I would suspect that are you doing mostly sell side advisory, or do you do both sell side as well as buy side?
No, we do predominantly sell side advisory, although we do sponsor, along with Becker, the law firm out of New York. We do sponsor a buy side conference in Kiowa Island every year. It's very select, about 70, 80 invitees to that. But we are predominantly a sell-side organization. And that is because at some point I made a decision not to jump both sides, so that way the sellers would not think, oh, well, you just represented the buyer, who do you represent? I wanted to keep it focused in on that. And, and we represent both founders, and we also represent some private equity firms in the sale of their assets. So it's that is our specialty.
Great. Well, that's excellent. So you've got either private equity or an entrepreneur that's grown their business, and you get to talk to them about now how do they really convert all of this blood, sweat, and tears and effort. Probably made a little bit of money while they've ran their business, but now they want to convert it to some enterprise value and some wealth for their family. So at least you get to talk to them when they're at a place to be able to do something interesting and exciting. Let me ask you this. Yeah. What's happening? Can you maybe give us a little kind of primer on what is happening in the industry and staffing right now? Kind of what's the last year or two look like for exits? Is this a good time to sell? Is this a good time to plan? What are you seeing as far as the overall momentum?
I'm going to start with an overarching comment, which is it is always time to plan on your exit. Always. The best exits that we see on a consistent basis over a decade of doing this is really those individuals who have elements of their exit ticked and tied and ready to go. And I like to use the analogy as unelegant as it is, of having all the bullets in the magazine and then one in the chamber, so you're ready to shoot at any particular time.
Right.
And those are typically going to ultimately be the best exits. Yeah. Because you never know when you're going to have something happen in your family. You never know when something's going to happen to your business partner, or something happens in the market that you've got to immediately, you have to immediately react to that. And you always want to be the individual who doesn't have to sell, but who can choose to do so. So what's been happening in the last couple of years, most people are aware that for a better part of a decade, M&A in the space got extraordinarily hot. And really, right before COVID, we were seeing all cash deals on staffing companies. And when we first came into the industry, there were only a handful of private equity firms that were coming in to be able to take out some of these founders, whether or not it was going to be on a platform basis or on a tuck-in basis. And so, but that really did accelerate as the economy heated up and the expansion continued for a longer period of time. We saw more and more of that private money coming into this market, and it just created a frenzy. And then the last year or two, it had really cooled off dramatically. Even if you take a look at SIA reporting numbers on transactions, they dropped off pretty significantly. And when that happens, then normally founders who have grown their businesses and they're excited about it, they say, well, I'm not going to get what I need to. And then they're only selling if they actually have to. Right. And so what happens is they dial back in terms of being able to bring their firm to market. Mm-hmm. And so M&A as a whole goes down. And meanwhile, a lot of times there's this demand that starts to build. And now where we are, especially this is being recorded, at the end of the second quarter in 2024, what we're starting to see is more certainty coming back into this market. And our phones are ringing with sellers who need help in exiting. And it's ironically, it's also we're also being inundated with buyers who are searching for companies to buy. So what I would tell you is that momentum is really building in the M&A in the space.
I love to hear that. I have seen that, considerable momentum shift over the last quarter as well. I absolutely agree with you. We finance a lot of our clients' acquisitions of other staffing agencies. We do a fair amount of leveraged buyouts for them, and that has accelerated dramatically over the last quarter. In fact, we've been doing somewhere between 2 and 4 acquisition transactions per month recently, and I'm seeing that excitement on both sides. So it's really nice to see coming back. And what I've also
I think the pipeline is going to continue to grow as well. I mean, I think next year is just going to be a banner year.
I agree. I absolutely agree. I feel like we're in the cycle where the next kind of 1 to 3 will be a banner year for both ways. And I also feel like there is a meeting of expectations. Like the valuations don't seem to be way crazy. It's like the buyers and the sellers get it. There is this kind of nice time in the market where people are being a little reasonable, and that's why deals are getting done. It's what I'm saying.
Yeah, I'll back you up on that one and say there was a time when even a relatively small light industrial staffing company could command 5.5, right? And it was just because there was a dearth of quality companies on the market, and so they would try to pick something up and be able to turn it into something greater. And you're looking at light industrial that even when I came into the market was trading at 3s, right? 3.5, 3.25. And, all of a sudden now they got 2 ticks up and you're like, wow, that's pretty incredible. But I think to echo your observations is that the expectations of sellers have dialed back and the patience of buyers has increased, so they can now start picking through and just saying, yeah, I think we're gonna buy that one, and this is what we're gonna pay. And if we're not going to pay that, then we'll go ahead and try to find something else. I think that parity is coming into the market between those expectations, and sellers have kind of pared down that irrational exuberance that we had a few years ago.
I absolutely agree. And when you have that kind of parity and that meeting of the minds, it's just a lot more exciting to see what's happening in the industry. You get a lot more smiles out of people on the other end that have said, listen, at least I've got what I need. And the other thing is, I mean, let's face it, there's a lot of founders that are getting to a place to where they may not have a family member to hand it down to, and they're getting to a place in their age and development. And also through the last 10 years has been crazy. We've had the COVID challenges. So we're at a place where a lot of people are looking to take a breath, they have some value created, and do something interesting. And obviously it's great for both sides, and it's great for companies like me providing capital, and it's great for companies like you that's advising. And so I really see these times, these next few years to be really good. So let me ask you this. Our audience, just for clarity, when you say 3 to 5, just explain really quick. Are you talking earnings, cash flow, EBITDA? Just help our audience understand a little bit of where the valuations are in a range, and kind of how you calculate that.
Sure. Let's just talk about a prototypical staffing company. And the phrase, if you're not familiar with it, it's earnings before interest, taxes, depreciation, and depreciation and amortization, EBITDA. And it's effectively a place setter for cash flow, for free cash flow. And what it's measuring is how much cash does a business throw off in order to be able to support the debt on an acquisition or to be able to support a return on that investment of capital. And so to get to an apples to apples comparison, there's going to be accounting standards that get us down to an EBITDA number. So that way you can compare two companies and just say, hey, relative to revenues, where are they in terms of their earnings? And so when we talk about multiples, what we're talking about, most companies are going to be sold as a multiple of EBITDA in our space. It's a little bit different when you're talking about pure recruiting companies, because that's usually, those are more project based. It's not recurring revenue. It's not recurring cash flow per se. There's huge hits of income. We'll talk a little bit more about that later on. But right. For the prototypical contract staffing type company, it is going to be a multiple of EBITDA. And if you think about it this way, it is, if I invest X amount of dollars, how long is it going to take me operating the way the current company is currently operating in order to be able to get those dollars back? And that also includes a profile, or I should say a discount for risk. What are the types of risks that are going on within this particular company? So that's what we usually mean when we're talking about what multiples. The biggest problem that we used to have, and we were just talking about this, you and I, a few minutes ago, which is when people don't accurately compare companies. And so they just said, my friend has a tech staffing company and he just got an 8. And meanwhile, they're on a light industrial company, and they go to the market and they get an offer of a 4 3/4, right? And they're just like, but I was told that I could get an 8 for the company. You have a fundamentally different company. And I think most savvy people are going to understand that. Anybody reasonable is going to understand that. But it's also understanding what your peer group is doing.
Yeah, excellent. And really, of course, that's where sell-side advisor comes in. You can make sure that they're getting the best price for their business, but then you help them with with really, what is this worth? What are the expectations? I'm sure you help them set those expectations in advance. But that's great. So thank you for explaining that. Essentially, what you have is multiples of EBITDA, earnings before interest, taxes, depreciation, amortization. So if I'm a $10 million light industrial staffing agency in a relatively good market, and in that relatively decent market, I mean geographically, okay? So geographically, in a relatively good market, I've got a top line of 10 million. What would be some of the reasonable ranges of EBITDA that would be what you would expect to see from my peers?
I'm gonna actually flip the question and say a little and make things different, because that is a really complex question. It's easy for someone to say a 4. There you go, really simple. Yeah. But let's get to a bigger picture. Come up to 50,000 feet.
Sounds good.
And the all companies are sold on risk and return. That's what it is right there. It is going to be the amount of risk that you have. It's going to be the amount of return that people perceive. And those two things are inversely related. When there is a huge perception of risk within a company through customer concentration or a lack of continuity in the owners, or it could be any one of those things, the risk factors go up. And when people see continuity within the business, or they have really good projections of a couple of years out, they got a strong management team, or they're really clean financials, then the risk goes down. When risk goes down, multiples go up. But here's the other part. When size of a company goes up, multiples also go up, and they go up almost disproportionately. And the reason for that is that the bigger a company, presumably, the less risk is going to be attached to it. And so when you're looking at a $10 million company, and light industrial company, and you're saying, yeah, it's probably going to be in the 4.5 range, depending on various factors, economic factors, and the quality of the company and the rest of that. The thing to understand is that a company 5 times that size is going to command a bigger multiple no matter what, just because it is perceived as less risk because of the innate size of it.
Excellent. Thank you so much for making that very clear. Definitely geography, size of the top line revenue, and you said it before, and it's really important for our audience to understand that there isn't a one size fits all multiple. If you are in a tech staffing business in a very competitive market and have a large market share, it's going to be a lot different than a Southern California light industrial staffing business that has 2 clients, right? And so certainly those are all the things that go into it. But
yeah, and that's it. I mean, and I think that's the hardest thing for most people to get their heads around. So say, for example, if you are light industrial in New Jersey, which is really getting hammered with regulation, or Chicago, where they're really kind of hammered, and you look at it and you say, what is the political risk of operating in this particular state? And what am I willing to pay for it? Versus if you go to a state that's typically being perceived as a little bit friendlier, it could be Florida or let's just say Georgia or somewhere else like that, then the perceived risk is lower. And people say, well, I'd be willing to pay more for a company in that part of the world than in this other part of the world. Or when I was growing up, New York State was a really rapidly expanding state. It had a robust economy, but it's been contracting for a while.
Right.
Weather, regulation, taxation, other things like that.
And everybody's moving to Florida.
Yeah. So the exact same company based up in New York may not be worth as much as it was in Texas. Right. And then you take it one step further and you say, well, everybody wants a company in Texas right now. I mean, that's the phone rings and everybody's like, got anything in Texas? Right. The phone doesn't ring and say, anybody says, got anything in New York? It doesn't mean that it doesn't have value in New York, but what it means is the demand for that Texas company is higher. So therefore, chances are it's probably going to command a greater multiple.
Which is why a seller needs a sell-side advisor that actually really understands the market and prices it right and gets them the best value for their business. And
it's funny, whether or not it's us or somebody else, there's something to be said on that. And that is, the sell-side advisor is going to be a Sherpa. They really are. And we swim in this water every day. We see the transactions come in every day. We see the economic environments. And we have, from a 10,000 foot view, we can actually see what's happening in those various markets. When you are in it and you are an owner and you're focused in on your own company and your own company's well-being and your immediate competitors and your own customers and your own employees and the rest of this, it's not your fault. It's not your fault, but you can become myopic. Right. And you start to just kind of focus in just on your world right there. And there are opportunities that people miss out all the time just because, rightfully so, they're so focused in on their own business, they're not seeing the broader opportunity to be able to sell and a sell-side advisor, again, whether it's us or someone else, use somebody. Okay. Yeah. Use somebody.
Yeah. Use somebody and use a subject matter expert. The other thing I've seen is a mistake is I've seen there's many generalist M&A firms out there. There's a lot of them. There's some smaller firms that target small businesses, but they're generalists. They sell everything. And I find that they just don't have the industry expertise to maximize value and really provide the kind of consultative advisor relationship that gets them what they need to deal with the nuances of staffing. So I agree with you. And my advice to prospects and clients all the time is use an industry expert that really focuses on staffing.
I have to agree with that. I mean, if you think about workers' comp, right, or any of the other major topics, you talk about labor law, because labor law is not the same for a regular company that it is for a staffing company. There's going to be nuances. Workers' comp is different for staffing companies that it is for just general companies out there. It'd be the number of incidences and the lookouts and the rest of it. And M&A is the exact same way, which is there are nuances within selling your staffing company that are different than other types of companies. And when you've seen, 10, 12 deals in a year, or 200 deals over the last 10 years, your reps, your at bats on that, allow you to see all the permutations and understand all the language that's going in there. And it just makes for a better, smarter, faster process when you're going through to sell a company.
Right. No, I get it. Sounds great. Well, let's talk about something specifically that you and I see and maybe opine on it for our audience. And the name of the podcast is The Growth Game. And so my audience is pattern matching things that, that other successful entrepreneurs in staffing are doing to grow their businesses. That's whether they want to sell it or they want to keep it, but it's all about what does it look like to grow the business. So let's just talk a little bit about growth for a little bit. If I asked you, what are the top 3 things that you see that are regular patterns in growing staffing agencies over the course of the last couple of years? I'd love to hear what those are.
Sure. I'm gonna talk about number 1, which is it actually goes back to something that Warren Buffett said, right? And everybody's looking at Warren Buffett for investment. He's always saying, the first rule of investing is don't lose money.
Yeah.
And the second rule is look at rule number 1, right?
Yeah.
And that is every client that you have is golden. And every client that you have, the revenue that they're generating, which drops down to eventually down to EBITDA, that really impacts the total valuation of the firm. And having those solid relationships and being able to ebb and flow with those clients and to be a trusted advisor to those customers, regardless of what it is. I mean, you could be staffing in tech staffing into Capital One, or you could be light industrial staffing into, I don't know, Van de Kamp's Fish or something like that.
Yeah.
It is being able to own that relationship and to be able to have such a good relationship with them that you typically tend to be the go-to supplier for them. We had a deal the latter part of last year where the client kept telling us, hey, we are awesome, we are great, we are award winning. And then when you get into due diligence on the transaction, they actually got some news back from some of their clients that they did not expect when they were being interviewed by the buyer. Right. And, a deal can blow up on that because they found out that they weren't as great as they thought they would. So growth strategy number 1 is absolutely taking care of that client, and making sure that you've got some longevity and you've got some real relationship building in there. And by the way, it's not just one person. The relationship has to be with the organization, because a risk factor is presented if you have one person in the organization owning that relationship. And we see this all the time in M&A, which is that person walks out the door, then all of a sudden, they either the client migrates to their new gig, or everybody's futzing around trying to go, who do we contact, or where does the relationship lie?
That's a great insight. So let me see if I can reiterate this and just add a little color to it. I absolutely agree with that. Going deep on the relationship for the clients you have and making sure they're sticky. I love what you said, and that's a great insight, that those relationships have to be more than just 1 or 2 people. Really, it needs to be multiple people on the client side. So you have a relationship that's deeper and stickier, as well as likely on the staffing company side. You don't want a 1-to-1 relationship where something goes the wrong way and all of a sudden you lose it. But going deeper, making sure that they truly, they really love what you're doing and love your service. Instead of going out and getting 10 more clients, make sure what you have is sticky and happy. And just on the side, before we go into number 2 and 3, how would you suggest, or have you seen successfully done, that a company will evaluate how happy their clients are instead of waiting to a process where the buyer is doing its due diligence and checking to see what they think about the company, and all of a sudden you've had this client for 5 years and you think they love you, and all of a sudden the buyer's like, you're ready to lose this account next week. Have you seen some things really work that gives a tangible result of, are they happy with you?
Yeah, but it is scary to most staffing companies, and to employ almost a JD Power type organization to come in and to say, hey, let me go ahead and interview our clients and let me get some feedback, some independent feedback on that. Because they're always like, there's a certain degree of, I don't want to know, I don't want to introduce the idea that they might be disappointed with us in some way. But
Yeah.
I think on a regular basis, whether or not you're doing it with an internal crew, which I think is less effective, or you're hiring an outside firm to actually come in and say, hey, here are 5 questions we're going to ask our customers and what their feedback is. I think it can be fairly instructive. And on
Yeah.
top of that, it allows you to at least say, hey, am I doing all the right things? Is this the relationship that you want to have
Yeah.
with your staffing company? And if you only asked that question, if you had to distill it down to one question, which is, if you couldn't change our relationship in any way, all right, what would that be? Now, if they say to you, yeah, we want lower prices, and you could say, I understand that. Everybody wants that. Aside from that, really, what would it be? Would it be in communication? Would it be in deliverables? Would it be in fill rates? What would that be? Because one of the things that you can do to grow your company rapidly is to actually get the feedback from your client and then present your new offering to them. And it was their idea, and they have to buy your idea because
You
it was
solved their
their
problem.
idea.
Yeah,
Yeah,
I
it was
love
their,
that. I
yeah.
absolutely love that. Go deep. Make sure your customers love you. Instead of pushing sales to go get 20 more customers, go deeper with your existing customers. Cross sell, make that relationship sticky and long term. That's a great growth strategy, and frankly, it's obviously one that creates more value in the business too. So let's see if we can brainstorm on the next 2. What do you think would be the
Sure.
next top 2 things that are patterns of growth in staffing organizations?
I think a lot of times what happens is staffing companies typically tend to run fairly lean, right? And what they do is they don't necessarily staff or stash enough cash to be able to, or they don't use debt really super effectively. And I know you've seen this, right?
Every day.
Where they end up being starved for oxygen, and so they're constantly grabbing for that next piece. And I'm talking more than just DSO, because DSO is really important, because you're going to get banged up on DSO if you are serving some of the big guys, General Motors, General Mills, General Oats, right?
Yeah,
One of
yeah,
those. You're the little guy, they're the big guy. I used to work for GE, right? So, if they decide they want to pay you in 90 days, you're going to get paid in 90 days. DSO starts to expand, right? So, not necessarily talking about that, but if you think about it, like taking money off the table and being able to put it away, so that way, when there's a new iteration of a software that's going to allow you to be more effective vis-a-vis your competitors, you have that cash right there able to roll out new ideas, innovative ideas. That when you see, a lot of times we'll talk, and this is part of number 3, we'll talk about A players, B players, and C players. A players being, I'll hire you at any time for any amount of money because I think you're a rock star. B players is, I will hire you for the right price when you happen to become available because I think you can help the organization. And C players are, I'm not going to touch you at any rate. Even if you come to me and you seem to be a good deal, I'm not taking you on. But when an A player presents themselves and you realize that they're probably going to cost you 25% more than the person that they're replacing, but the amount that they're generating into the organization multiplied, when you bring it down and then multiply it out by a valuation factor, is significantly greater. Stop hemming and hawing about how much it's costing you to hire this person because they're going to get there. And companies that can't manage their cash don't have the choices of hiring the best level of people.
Yeah, it's well said. I love that, and I see that all the time. You have to be able to reinvest in the business, set some cash aside. Don't blow all your profits in one year on the fancy new Mercedes when you can think about, hey, what is that going to do for me long term for the family, and having conserving some cash, and of course having quote unlimited funding capacity is super important. It's one of the reasons why I always recommend that staffing organizations specifically, even if you can, don't fund with a bank. I say it all the time because that little extra incremental capital cost that you can pay me or one of my dozen competitors, but yet you have the unlimited ability to double, triple, quadruple your business, and the banks are going to keep you down. Like, always have access to that, to capital to grow the portfolio when you need to fund the payroll, but keep something aside to reinvest. So I like that. I align with you 100% on those two things.
Yeah,
And
I'll say it too. It's a dry powder thing, right? It really
right.
is, and that is when you need the money, don't go hunting for the money. You go hunting for the money when you absolutely don't need it. Have it
Well said.
there in the background. Put the line of credit that's out there. Put your ABL place that is so that it's out there. Put all of these things out there so that way
Yeah,
when the opportunities present themselves, you have it.
I agree.
And I don't see staffing companies really managing cash that well from that perspective.
Yeah, I agree. I don't see that when they come in the door for me, but I definitely see that when they work with us. And I'm not. This isn't an advertisement for what I do. That's not what I'm saying. I see that there's a behavioral change when they are many times companies come to us and they're stressed out about making payroll Friday because they just got a new client, and that's the worst thing to worry about because I mean, if their margin is in that 15 to 18% range and they may be paying us a point or two, like to have the ability to double your business and not stress about making payroll just makes it just doesn't make sense. That's why we take companies high growth startup to 40 million a month, right? It's the ability to know you have it.
Yeah, and I think that it's interesting that you should say that as well because there are high class problems and there are low class problems, right? And you're really trying to get those penthouse problems. And the penthouse
Right.
problem is I've got all this business. I got to figure out a way to be able to take it on and to be able to fund it.
Yeah.
The low class problem is I've got all this infrastructure and I have no business. And
Exactly.
so the way to get to the high class problems is to be able to anticipate that they're going to be there and to be able to set up your financial resources in such a way that you're spending through cash really that you're gathering your cash very quickly and you also have your lines out and you have enough credit facilities behind you to be able to ebb and flow and flex with the market.
I agree. I love that. So that's great. Excellent number 1 and 2. And number 3, I think you kind of started, but let's just reemphasize it. It sounds to me like your number 3 is all about the people and the A players, right? And I'm a huge believer in that. Talk to me a little bit more about how important that is to growth of staffing. To what does it take to reach and find and retain those A players?
Yeah, it is. I could write a pretty long treatise on this one. The single most important thing that you've got in your organization are the people. And let me tell you why. I'm going to go from the back end and then I'll go to the front end. So whenever we get a phone call from a private equity firm to buy a company or from a strategic to buy a company, the first things that they ask is really simple. How big is the company? What's their EBITDA? That's usually number 1. So we just set that aside over here because they're just trying to get scope and scale.
Yep.
And then the number 1 question we get asked right behind that one is what does the team look like that runs this company? And specifically, what they're trying to figure out is whether or not the only one with the magic formula is the founder or the CEO. And that is a major risk. A lot of times I'll ask a question in a very kind of oblique way. I would ask you, Paul, I'd say, Paul, when was the last time you're the CEO of a staffing company? I would say, in a very casual way, when was the last time you took a vacation? Right. And where'd you go? And it sounds like I'm talking about you as a person. But the correct answer to that is, last summer, my wife and I went to Greece for 6 weeks and we had such a great time. It was amazing. If I hear that answer, I know that company is saleable.
Okay? That is brilliant. I absolutely love that. If there's one takeaway that every CEO of a staffing organization should ask themselves, and I absolutely love this, is can I go on vacation and shut my phone off for an extended period of time and enjoy myself while my business runs itself? I love that. That's brilliant. And that's going to answer whether or not you need to work on your team or not.
That's the whole thing and where we see value in an organization really start to decline is when the CEO is the only one who knows stuff, or when the CEO is the only one who can do stuff, or when or you've got so much churn in the organization that you lose all institutional knowledge and everything is just becoming transactional. Those are the companies for us that are huge red flags because nobody wants those types of of clients or those types of acquisitions. So now you start backing into that and you say, all right, well, how are you building out this team? Part of it is a self-examination, and this is true for any growth company, which is how much do you trust the people around you? And if you don't trust them, are you hiring the right people? If you don't trust them, are you hiring them with your own sensibility? Notice that I didn't say they don't think the way that you do, because I absolutely am a contrarian. I want to hear everybody else's opinion, and I really listen to the people that don't agree with me.
I could not agree with you more. It's how I built my organization. I love somebody coming to me and having an opposite opinion, having the chops to tell me. And those are the people that get promoted in my organization.
Yeah, it's funny because there was a phrase in Much Ado About Nothing. I think it was like 1991. Denzel Washington, Keanu Reeves, Robert Sean Leonard, and it's the prince talking to another character, Beatrice, and he looks at her and he says, "Your silence offends me," right? And what he's saying is, I want to hear your opinion. I want to hear what you have to say. And so a strong team, especially within staffing, is the one that brings the contrarian view in and says, maybe we should do this, maybe we should do that. It doesn't mean that you always accept it, but it also means that the culture is healthy enough that the lowest guy can call the CEO out on a strategy because they see something that other people don't. When that happens, Paul, now they know that they are in fact valued in the organization and they don't leave. And when they don't leave, you've got continuity within the business. When you have continuity within the business, now you can leave because you know that the people are going to be making the same decisions that you as the leader would make. Notice what I said is the same sensibilities does not necessarily mean the same opinions. It means they value what you value.
That's brilliant. I love it. What a great Shakespeare quote. Your silence offends me. I love that. I'm going to bring that up at my next management meeting.
and you'll look very erudite. So there you go.
Yeah, thankfully, most of my team has no problem talking, so that's good. Even if I talk too much, they still make sure that they get their words in. That's excellent. Well, I
said to one of my guys the other day, "You are suspiciously quiet."
Yeah, suspiciously quiet. That's great. This has been an amazing conversation. I absolutely love it, Patrick. I think super helpful for my audience. I really appreciate that we went deep on what it looks like to match the growth. And of course, when they're done growing and they've built the business that can run without them, then they can hopefully sell it and make some family wealth. Maybe we have time for just one success story. If you look back in your career and is there one staffing company sale that you just go, wow, that went perfect? Maybe just a few subjective things that you found out of that story.
Yeah, I will tell you this, and I'm going to give you a character trait to start, and then we'll back into the event. And the number one character trait for a successful exit is humility.
Ooh, I love
number
that.
one, right there, humility. Arrogance kills deals. Time kills deals. I know it all kills deals. And I'm thinking about a pretty significantly sized staffing company, and light industrial that we sold a couple of years ago. And the CEO actually said, I've never actually sold a company. My entire life is in this company. I'm not exactly sure what to do or how to do it. And so we went in and kind of examined the entire company, and we did it. We were looking at some of the major risk factors and the opportunity factors. Remember what I said? All companies are sold based on return and risk and the perceived therein. And so the first thing that we're looking at is size. And the company obviously had the right size, so therefore, it's going to command a bigger number. And then we started looking at the individual risk factors, which are, number one, the team. I already talked about that with you. Number two is the financials, whether they're reviewed, compiled, or audited, and what we can sell there, depending on the cleanliness. Number three is going to be the customer base and the transferability upon sale of those contracts, and also if there's customer concentration and what are some of the relationships that you had. Number four focuses in on the growth plan and saying, hey, what is it going to look like 2 years out? And by the way, that's a post-COVID convention, which is people want to know what the company is going to look like 2 years out. And then the last element is going to be the business processes, how you're bringing on recruiters, how you're bringing on talent. What do you have in terms of infrastructure within the business? So those 5 risk factors against the size and the EBITDA. the best transactions that we've had, and this one in particular, we got engaged about a year and a half ahead of the actual exit event. A year and a half.
Wow.
And we went through each of those things, and we met on the quarter, and we said, if you improve these elements, if you improve your team over here and get them more ready for it, if you are able to do to get some reviewed statements in there ahead of time instead of just compile, make sure that you're on accrual accounting. We went in there and able to say, let's take a look at a 2-year growth plan, especially this was in a pretty hot market. Some of the companies that are coming in and the industries that are coming in. When we did that, we had, if you put it on a multiple, if you say that they were going to get X, all right, they got 30% over X, just based on some of those improvements. So they got a really, really significant bump in that. And because you start having these conversations earlier that are centered around M&A, when it comes time to do the management presentations, and when the company goes to auction and you're bringing in all these buyers, you have been swimming in that water for so long, it just flows off the tongue, and the level of credibility goes up and the level of trust goes up. When the level of trust with the buyer goes up, the transaction has a greater chance of close. And I will leave you with these 4 things, Paul. Whenever we're trying to sell a company, we are looking for 4 fundamental elements. We are looking for valuation. We are looking for speed to close. We are looking for surety of close. And we are looking for cultural fit if there's going to be any remnants of the company coming back. Unfortunately, most sellers out there, what they do is they only focus in on one thing. What is the multiple I'm going to get on this EBITDA? Yep. Right. What's the valuation? And all the other 4 kind of go by the wayside. You want to have a successful exit. You focus in on those 4 things. You want to have a really successful exit. Start 18 months or 2 years ahead of time, build some relationships, and make sure that you get a valuation on the firm. Look at it and say, what are my weaknesses? What are my strengths? How do I turn those things into advantages for me? And you'll have a successful exit.
Yeah, that's brilliant. And I appreciate that you highlighted that humility is so important. I'm not sure if you follow me on LinkedIn, but we put out a lot of video content, and I talk about humility all the time. In fact, I find that humble CEOs make the best CEOs. And, it's really the opposite of what we see portrayed by the kind of the billionaire club. I've said this multiple times. It's almost like that kind of PR of to be the most successful entrepreneur, you have to be this certain way. And I completely disagree. Maybe that works for the 5 of the billionaires in the world, but even then, you look at some of the humble ones, and they're actually the most interesting ones. But as far as just middle market America, humility in business equals a successful person. And I appreciate you said that even in a transaction to sell your business, have some humility and find out what you don't know. Ask an expert and learn.
Can you be led? Can you be guided? Because you hire attorneys in the M&A space, specifically in staffing, accountants that are good with staffing, your M&A guys that are going to be in staffing, but even though they're experts, can you actually subjugate your own need for validation and listen to their advice and say, maybe you in fact do know a little bit more?
I love it. That's great. Well, Patrick, that's amazing. We're coming to the end of our time slot on the recording studio, and it's been a great time today. I really appreciate you coming on the Growth Game podcast. It's been a really interesting conversation, and I know my audience is going to really love some of the tidbits that we've been able to extract out of both of our years of experience helping staffing agencies and helping them grow and evolve into whatever's next. So thank you so much. Again, this was the Growth Game podcast. Please make sure to subscribe and continue to follow along other excellent pattern matching techniques to grow your staffing agency. Again, our guest was Patrick Morin. Thank you again, Patrick. We'll talk again soon and continue to develop our relationship as well.
Absolutely. Thanks a lot, Paul. I enjoyed it.